Well, hello there, and happy birthday, economic recovery. As June came to a close, the current economic recovery and expansion turned 8 years old, the third longest since the end of World War II. Now, that's according to data compiled by the National Bureau of Economic Research, or the NBER, which marked the end of the Great Recession in June 2009. The NBER bases its calls on data that includes employment, sales, income, and industrial production. In a vacuum, 8 years may not mean very much to the average person, so I will offer some perspective. Including the current economic recovery, there have been 12 such recoveries since World War II. The 8 year or 96-month-long expansion has only been exceeded by the expansion that began in 1991 and lasted 120 months, and the expansion that began in 1961, which lasted 106 months, or nearly 9 years. The shortest one survived only 12 months. It began in 1980 and fell victim to then Fed Chairman Paul Volcker's decision to use monetary policy, sharply higher interest rates, to crush years of high inflation. With the short explanation out of the way, you may be asking, what does that mean to me and my investments? Or the recovery isn't young anymore. Is a recession around the corner? Expansions eventually come to an end, and that's a given. But they don't die of old age. Instead, they historically come to an end due to economic excesses, like the tech boom of the 1990s or the housing boom of the last decade. Or the Federal Reserve raises interest rates too high too quickly, discouraging lending and consumer or business spending. Now, one of the hallmarks of the current expansion has been its slow and boring pace. For many who have seen wages stagnate or haven't experienced the benefits from the modest at best expansion, there's one silver lining. The slow pace of recovery has failed to stoke the euphoria in real economic activity that can sow the seeds of dangerous excesses. It has also led to a super cautious Fed that has been slow to tap on the monetary brakes. Now, economists have done a poor job of calling turning points in the business cycle in the past, so I won't try to predict when the next recession will set in. What I can say is that it is important to make sure you have a reliable retirement plan and that you aren't risking more money than you can afford to lose. Do you have the time to wait out a recovery from another 30 to 40% drop in the market? The investment plans we've recommended for our clients take unexpected turbulence into account. Remember, trying to time the ups and downs in stocks is rarely profitable longer term. In reality, it only delays the day you reach your financial goals. Now, following the markets, though, as of the end of June 2017, and according to the Wall Street Journal, the Dow Jones Industrial Average is up 8% year to date, and the S&P 500 is up 8.2%. Both have ended the month relatively flat. I hope you found this review to be educational. Let me emphasize again that it is our job to assist you. If you have any questions or would like to discuss any matters, please feel free to give me or any of our team members a call. As always, we're honored that you have chosen Pineywoods Financial for your savings and retirement needs. Be sure to check our website for a list of current client and educational events, and tune in on Saturday mornings to 8:60 a.m. KSFA at 8 a.m. to hear our sponsored show, Financially Speaking. I'm sure you'll be glad you did. Oh, and one last thing. Be sure to download the PDF for 5 tips to help you get more out of retirement than just financial security.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.